Hi, would you trade a 90% win rate trading strategy? Most would immediately say yes, but that instinct can be detrimental. And I'm going to show you the math that they're missing. For a lot of people, the win rate feels like the answer. It's satisfying, it's simple, and, it feels safe. However, trading isn't graded on that. Trading is graded in dollars or euros. And if you have a 90% win rate, but an average win amount of, let's say, $10 and an average loss amount of $100, then if you count in fees and so on, then you will still end up with a loss overall. Over time, you're still going to lose money. And of course, there's different paths, different variations, like by coincidence, by random chance and luck, you might still end up with a profit. However, the point is that a high win rate really does not guarantee anything as to profitability. So let's go through that scenario concretely. You start trading with real money and you immediately win the first trade. And then the second, third, fourth, wow, you're really winning. And then up until the ninth trade, your account is at $90 plus, okay? Because your average win is plus $10. However, the 10th trade wipes it all out, minus $100. And that's how quick it goes. And the math is this. You multiply the win rate times the average win, in our case 0.9 times 10, that equals $9. And then you multiply the opposite of the win rate, so to speak, the loss rate or the losing rate, times the average loss, in our case 0.1 times 100, so that's, or minus 100, so that's minus $10. That's how the calculation goes. And then you also factor in fees. Let's assume a $1 fee, and then on average, every trade on average gives you minus $2. So that's your expectancy. Your expectancy is minus $2 with this setup. And in this case, the expectancy is negative, which is the biggest thing you want to avoid at all costs. Because if we re-roll a few times and we look at different paths, because this is all averages, okay? So your mileage will vary. And you might by chance go up a lot, or by chance just always hit the 10% and lose much more money. But on average, it goes down slowly. But looking at different paths, the expectancy shows us, a negative expectancy shows us that a lot of paths will go down. So the expectancy is the real metric to watch. It basically means, on average, how much does each trade make? And if it's positive, and maybe even highly positive, or like highly in the positives, then that means you have a real edge. And if it's negative, that means your strategy is unprofitable. So we can translate the win rate as how often you feel good, but the expectancy is actually whether you will get paid. And what this means on the flip side is that a low win rate trading strategy can actually be profitable. Let's take an example of having a win rate of 0.4 and an average winning trade of $300 and an average losing trade of $100. So in this case, we win less often, but we gain more per win. And here the expectancy, we calculate 0.4, the win rate, times $300, the average win, and that's $120, plus the, so to speak, losing rate, the loss rate, 0.6, 60%, 0.6 times 100, which is 60. So if you take plus 120 minus 60, that comes out to 60. So your expectancy is 60. So it's actually a really high expectancy, or quite high expectancy. Depends a bit on how much you trade, of course, how many trades you do. And so this means you have a real edge. Of course, if it's the case in live trading and not just in backtesting, because it needs to be also be the case in live trading, of course, for you to have a real edge. But that shows how a low win rate can still lead to a positive expectancy and thus a profitable trading strategy. And this feels worse and rougher emotionally, but the math is healthier. And the equity curve in a lot of cases will then also look rougher, but overall it will still point up. And so what this means is you cannot look at the win rate in isolation. You need to look at the whole package. And this ties in nicely with the risk-reward ratio. And you can calculate this from historical data, for example, with the average win and average loss that you achieved. It can also be a goal, but let's just work with the 90% win rate example. There we had an average win of $10 and an average loss of $100. So just eliminating zeros on both sides, we get 1 to 10. So it means for every $10 risked for loss, we would, on average, get $1. So we risk $10 and we get $1. However, that you cannot be profitable with a 90% win rate for that, because with a 90% win rate, the risk-reward ratio should be more like $9 risked, and you gain for every $9 risked $1, because you make that up, of course. But to be sure, and also considering fees and commissions and spreads and slippage and so on, you need to, of course, be above that. So you need to have a higher risk-reward ratio. So for example, for every $8 risk, you get $1, and then, including everything, including commissions, you're going to be profitable with a 90% win rate. So let's look at this more concretely with more examples. If you risk $100, your average loss, for $300, your average win, then you can have a lower win rate to still be profitable. But if you risk $100 to gain $10, you need a very high win rate to still be profitable. And it's very important here to look at fees. Those can be the silent killers, so to speak. Because if your expectancy, excluding fees, is close to 0, it might be below 0 if you include fees. So that's actually your break-even win rate. Because mathematically, you can have a win rate of 90%, a risk-reward ratio of 9 to 1, or 1 to 9, and be profitable or just break even. But then with fees, over time, it's going to be unprofitable. So that's very important to consider. So it's less about, does this win rate look good, but does this win rate, work with this setup? Does this win rate result in a profitable strategy? So here's the takeaway. You should first look at the expectancy, then win rate and risk-reward ratio, and then average win, average loss, and fees. And look at the whole picture. I'm also leaving out some metrics, of course, like the Sharpe ratio or Sortino ratio, the Kalmar ratio, all of these things. However, look at the big picture, not just the win rate. Because the goal isn't to win often, it's to still make money when you have a lot of trades, when the trades add up. So I hope this helped and I was able to teach you something. If you enjoyed this, please leave a like and comment down below what you want me to make the next video on. I'm really trying to make videos. They're taking time for me to get out, so I appreciate your patience. And otherwise, as I said, hit the like button, smash the subscribe button and the bell, and thank you for watching.